please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, the Economic Affairs Secretary Subhash Chandra Garg is addressing the press conference. Let's go to him right now. He may be speaking on the borrowing calendar.
In detail, the borrowing calendar as well as the press release. I will highlight some major points of that decision. As you are aware, fiscal deficit for 2018-19 is 6,42,276 crore, which is 3.3% of GDP. The budget had indicated a gross borrowing program for the GSECs. Now I am talking about the government securities. Of rupees 6,05,539 crore. This is inclusive of the buyback which was planned, right? Without buyback, so if we exclude the buyback amount, the gross borrowing planned was 5,33,598 crores. There is a repayment of 1,43,478 crores. So that, taking that out, the net borrowing with buyback was 4,62,061 crore, and without buyback it was 3,90,120 crores. In addition, the budget had indicated a net T-bill addition of 17,000 crores, and therefore the budgeted number for GSECs, including the T-bills, on net basis, excluding the buyback, is 4,07,000 crores, 120 crores, right? The government and the Reserve Bank together has decided to reduce the buyback by about 25,000 crore. So again, 71,000 crore or 71,941 crores. The buyback has been reduced by 25,000 crore.
For FY19.
For FY19, right. Second decision taken is that we expect larger flow of funds in the NSSF, and budget had spoken about 75,000 crores to be used for funding fiscal deficit. It has now been decided that instead of 75,000 crores, we'll use 1 lakh crore to fund the fiscal deficit. So that in a way would be further reduction. From 75,000, we will raise it to 1 lakh crore, right?
Small savings.
Small savings, right? So taking all these things into account, we are planning gross borrowing of rupees 2,88,000 crore in H1. 2.88 lakh crores, 2,88,000 crore in H1. Just for your information, that the actual H1 borrowing undertaken last year was 3,72,000 crore. So as again, 3,72,000 crore. So as against 3,72,000 crore. Last year was 3 lakh. Maybe Prashant is pointing out that my number is incorrect. It's not 3,72,000 crore. No. 3,12,000 was originally planned. You are not correct. So it has been reduced to. I know. So my number was right. So let me repeat for your benefit. 2,88,000 crore is what we have planned for H1 next year. Last year, that means the year which is going on, 17-18, we had taken up the borrowing of 3,72,000 crores. Right, so compared, it's on gross basis. So gross borrowing last year in first half was 3,72,000 crore. Next year in first half we will undertake only of 2,88,000 crores. So it then represents a substantial reduction compared to the last year. This amounts to 47.56% of the gross borrowing program. 56%. 47.56% of the budgeted gross borrowing program of 6,05,539 crore. And 53.97% of the gross budgeted market borrowing program excluding buyback. So if you exclude the buyback planned, it is 54%. If you include that, which was the budget statement, then it's only 47.56%. Just to again compare and give you a contrasting view, in last 5 years, our first half borrowing has ranged between 60 to 65% of the annual borrowing. Right? There will be in all 24 issuance in first half of rupees 12,000 crore each. So 24 issuances of rupees 12,000 crores each in the first half. Now I move to another decision which has been taken, which is a shift from our past practice. This, so far I was giving you about the quantum numbers and that kind of thing. This is in terms of issuing government securities in different buckets, right? So we would be introducing issuance of government securities in 1 to 4 years bucket as well. So far we have not been issuing securities in 1 to 4 year bucket. From this year there is demand from the market that there should be some issuance on the shorter end of the market. So to respond to that and to reduce pressure on the 10-year benchmark securities, we will be issuing the securities in 1 to 4 year bucket. We have also realigned some of the borrowing from the 10 to 14 year bucket to the 5 to 9 as well as to the longer bucket. I'll give you the numbers which would be there in different buckets. In the 1 to 4 year bucket, we will issue 8.3% of the of H1 programs. So 8.3%. Last year it was 0. In the 5 to 9, 8.3%. In the 5 to 9 year bucket, we will issue roughly about 25% of the issuance. Last year it was 20.6%. In the 10 to 14 years bucket, we will issue 29.2% of this 2,88,000 crores. Last year it was 52.2%. It is 29.2%. 2%. 52.29% last year. This year 29.2% in the 10 to 14 years bucket. 15 to 9 years bucket, it would be 14.6% as against 12.6% last year. In the 15 to 19 year bucket, 14.6% in H1 2018-19 as against 12.6% last year. 20 years and more, 22.9% as against 14.6% last year. So this would be the distribution of the market borrowings, gross market borrowings across different buckets, right?
So last year would be current year.
I know last year, whenever I mean last year, is 17-18, right? Yeah. Last year it's understood. So we are now discussing next year's program, which is the, right? Then we will also be introducing this time inflation index bonds. We have been doing flexible rate bonds, FRBs, but we'll also be introducing inflation index bonds linked to CPI. Earlier, couple of years back, we had done WPI linked index bonds, but we will now be doing CPI linked index bonds. Both these together, the FRBs and the CPI linked inflation index bonds, will be within 10% of the overall issuance program. Right? Now
within or up to?
Sorry?
Within or 10%?
Within 10%.
Within 10%.
Right. It means the same. Within and up to is same. Right.
Will be part of the borrowing program.
Sorry?
Part of the borrowing program?
Absolutely. So of 2,88,000 crores, gross borrowings planned for H1, up to 10% would be issued in the form of FRBs and the inflation index bonds.
10%.
10%. That means 28,800, you can roughly say. Okay. I now move to the T-bills program. So we propose to make 13 issuances of T-bills in the first half in the first quarter. In the first quarter.
Yes.
I stand corrected. First quarter, not first half. Of rupees 15,000 crores each, aggregating to rupees 1,95,000 crore. During this period, T-bills of rupees 1,53,000 crores will also mature. So in effect, there would be net issuances of T-bills of only 42,000 crores. This might be adjusted depending upon the liquidity and the cash position of the government. But it would not be exceeded beyond this limit. We also have planned switching program next year. As indicated in the budget, that amount is expected to be about 28,000 crores. But that is entire year, it's not first half. Last initial remark which I need to make is that the ways and means advance limits have been kept at last year's limit. So in last year, in Q1, we had 60,000 crores ways and means, and in Q2, we had 70,000 crores. So it remains at the same level. With this program, we are absolutely confident that we will be able to meet all the expenditure requirements of the government without getting into overdraft situation. We have one more instrument available to us, which we will use, is the cash management bills. The budget allows for about 1 lakh crore of the cash management bills to be issued. So that we will use. So with ways and means, cash management bills, our calculations suggest that we will be able to fund the entire expenditure program with this reduced level of borrowing. Thank you very much. One by one. I'll move from this side, so you can ask and then I'll move. We are issuing the borrowing calendar. We will also be issuing the calendar for switching, if possible, and also the sovereign gold bonds. But that would follow. That's not being issued. Yes, go ahead.
So then you just said that you expect higher collections to small savings. Can we expect that the interest rates for small savings which you fixed in April 1, they expected to move up because they
I didn't say that we expect higher collections. I only said we will use higher collections available for funding fiscal deficit. We, in a typical year, our net flows into the NSSF, including the maturity proceeds of the securities earlier issued, ranges around 175 to 225 lakh crores. We had planned to use 75,000 crores for this, and for the we have other obligations also to undertake through NSSF. This year we plan to do 1 lakh crore.
So my question was basically April 1. Do we expect the interest rates on small savings to go up because the yields have been high for the last 3-4 months?
No, not in this quarter.
Sir, is there any proposal to raise the FPI's limit in the cash rate now?
FPI limit is a matter of discussion between the government and the Reserve Bank. Active consultations are on. FPI program would be issued by the Reserve Bank around the first week of April. Decide. Any questions? Yeah.
So since we are seeing a reduced borrowing program in the first half from conventional.
Please let's.
From conventional years where we used to see 60 to 65% of the borrowing happening in the first half, is this an indication that the government will ultimately borrow less from the budgeted amount?
See, certainly this is no indication that we are pushing more towards second. When I gave you number, I was comparing it with the budgeted numbers. If you factor in additional flows from elsewhere, our second half would not be crowded. So there is no shift to the second half. It means that overall borrowings would be lesser
So
from the budget.
It's to be below 6.06 or whatever.
Sorry?
So gross borrowing for next financial year could be less than 6.
That is the conclusion which it follows, yes.
From the market.
Just a slightly different question. This is not to do anything with the borrowing program. DMD leaders.
We will let us first get through the borrowing program. And then we will, yeah.
So you said the borrowing in the H1 is lower. So this question has been raised. So overall, you expect it to be slightly on the lower side, number one.
That's I just said, yes.
By how much, sir? If you don't mind, sir. Clarity.
No, I just made it clear that 25,000 crores we are expecting it to fund from the small savings. We'll reduce the buyback program also. So all that would reduce the demand which we had budgeted at that time from the markets. Market borrowing program would be definitely lower than.
So sir, it's a simple equation, 50,000 crore.
You can conclude that at this moment. That's what we are saying. Right.
So is this switch that you've done that from compared to last 5 years, is this because the yields have hardened and you want to manage the yields, or there's a fundamental switch you are changing that borrowing will be lesser in the second half, first half, and more? So what is the trigger for you to change?
See, the objectives are multiple. It's not one single. One, we want to reduce the load on the market. And when we have equally effective and good means available, so we can reduce the, but many other measures which you saw, like issuing the bonds in 1 to 4 year bucket, reducing high concentration in 10 to 14 year bucket, are meant to provide the supply which matches the demand better, and therefore that should have a good smoothing effect and soothing effect on the yields.
So considering the banks are already running on excess SLR, there will be enough demand for G-Secs in the first half?
See, G-Secs demands from banks come from SLR as well as what is known as LCR portfolio. So LCR portfolio is also funded from the G-Sec. So bank have been reducing somewhat for the SLR side because SLR is coming down, but their need for the LCR portfolio is there. So LCR is not marked to market.
Well, at the outset, it does look like Diwali is coming in the first half of the borrowing period, not in the second half. This is a huge positive surprise for the bond markets for the first half. We can forget, I mean, we can leave the second half and worry about it later. Versus 3.72, only 2.8 lakh crore. Yes. So that is, as you calculated, 22% less. And within that, what you call the belly is the 10 to 15 year tenure. That used to be, as the secretary pointed out, 52% of the total borrowing, more than half, because the 10-year paper has a lot of appetite. That slashed now to 29%. So as it is, the overall borrowing is less by about 95,000 crores compared to last year. In that, about only 1/3 is going to be the 10-year paper. So I'm just, a rough calculation, 10 to 15 was last year about 1.8 lakh crore of paper. This year it is going to be less than 1 lakh crore. So my sense is this will be very positive. And of course, there is this new bucket of 1 to 4, which the market wanted. You know, after all, Viral Acharya gave that huge dose saying that, you know, why are you buying duration? The bank said, but then you are giving duration. At the moment, the government is saying, okay, we will give you shorter term paper. I would assume that also will be taken positively. We have a guest.
Yes, Mr. A. Prasanna, the Chief Economist at ISEC PD, and Amandeep Chopra of UTI Mutual Fund, as well as Ashutosh Khajuria, ED Federal Bank. All of these gentlemen are joining us. Thank you very much, all of you, for being here with us on CNBC TV18. Mr. Prasanna, I'll start with you first. What do you make of the government's announcement today? Obviously, a big cheer for the bond market.
That's right. I think most of the issues raised by the market participants have been addressed. I think, like you were all discussing, I think the issues of high duration in the market, that was something which was really causing a lot of pain in the market, and that's been addressed. But again, like you pointed out, obviously we have to see the second half. Probably it's a bit more backloaded than usual. Also, a couple of other things might come into play. One is if there is some fiscal slippage, that will add to the pressure in the second half. And third thing we have to remember is the small savings collections, right? I mean, as banks also increase deposit rates during the year, it's possible that the small savings collections could disappoint. So there are a lot of those risks are stored for the second half. But at this moment, yes, it's a big relief, and it's more than what the market had kind of hoped for or bargained for.
Oh yes, looks like much more. At least the dipstick survey I was doing in the morning. Prasanna, just coming back to you in a minute. Mr. Khajuria, what do you think the reaction of the bond market is going to be? Are we going to get, you know, a yield less than 7.5 tomorrow itself?
I'd not be surprised, because there are three issues on which the market was worried. The three concerns, all three have been taken care of. One was having more of, you know, I mean, lower duration issuance, and 25% issuance is in 5 to 9 year market. And let me share with you, I think there are lots of banks who do not allow, because I'm not speaking from the PD angle, I'm just speaking from the bank's angle.
Yeah.
These, you know, their investment committees don't permit the banks, I mean, the dealers to buy more than 10-year paper. 10 years is the liquid one. So up to 10 years it's permitted, and beyond that they are not permitted to buy in AFS book. If at all somebody wants to you know, bet on interest rates, then he can buy in HFT and square it. Now with this, you know, 25% issuance happening in 5 to 9 years bucket, I think these you know, I mean, investment departments would be happy to do that, you know, and banks may participate in this market borrowing program, which earlier it was thought of that they may refrain from because they have excess SLR and all sorts of things. So that's one point. I mean, tenor is one point. The second one is the percentage of issuance in the first half. That also has been taken care of, less than 50%. You know, 24 issues of 12,000 crores each. I mean, quite reasonable number, despite having higher redemptions in the first half. That's to be seen, you know. So that for that, I think they are using CMBs and all that, and that would be cheaper for government to do it first time. To cut the cost, to cut the interest cost, they have done a wonderful thing. CMBs or the WMS would be used to take care of, you know, and higher redemptions and all. I mean, good move. Certainly a very good move.
Okay. Amandeep.
And FRBs again,
yes.
You know, I think
10,000 crore FRB plus inflation index, if I heard them right.
Crores. I think 10%, 28,000 crores of FRBs and capital index bonds.
Yes. Sorry, 10%. Okay. More than you bargained for.
Certainly.
Okay. Amandeep, your arithmetic, what is the net borrowing number now? Much less than previous years. What would it be?
Oh, yes, much less, Lata. I mean, you know, clearly with the gross of 2.88, and I believe there are maturities close to about 90,000 in the first half itself. So that really does leave a lot less of net supply in the market for the first half. You know, this is clearly a big surprise from what our earlier numbers were, and it looks like the government has clearly broken away from the earlier pattern of, you know, keeping the first half at least about 60 to 63% of the overall gross borrowing.
Okay.
So yeah, I mean, the number clearly looks to be closer to about, you know, little over 2 trillion odd rupees.
Do you wish you hadn't shorted the market today?
Thankfully we didn't, Lata.
Okay, all right. Okay, but did you go long? Then you would be sitting on a gold mine.
So, well, not particularly.
No, okay, what do you expect the market to do tomorrow?
I think it will definitely gap down in terms of the yield. I think 7.5 clearly will be broken. This is a big trigger, and you're heading into the financial year end as well.
Yes.
That also always is a little bit supportive. So I guess with this news on the numbers, and as we head into the financial year end, I think very supportive for ensuring that the 10-year closes, in my view, at least anything between 15 to 20 bits lower than where we close today.
No, the bond market doesn't seem to have got a whiff of it because the 10-year has ended at 7.62 today. But looks like the equity markets have got a whiff of it. Today we had a monster rally in the bank Nifty and especially in the public sector banks. Canara Bank rose 10%. Bank of Baroda, SBI, all up 5%. So it was a huge rally. Of course, a short covering rally. I'm joking about anything leaking. But clearly, banks are having a good thing going over there. So tomorrow, not just a rally in bonds, but a rally in bank stocks for sure. Prasanna, your guess as to where the bond markets might open tomorrow? As also, what might it do in April, May, June? What can the ranges be?
Yeah, I mean, obviously it's difficult to hazard a guess what the gap opening will be, but I agree it should go below 7.5 tomorrow itself and probably go to 740. It should test 740 as well, I would say, tomorrow itself.
Okay.
And in terms of a range for April, May, June, my range would be 720 to 7.5.
Okay. Is this a legitimate expectation that small savings will increase, or are they being ambitious?
I have my doubts. I guess we'll have to see how the bank deposit rates move. Also, I think what has happened in this calendar also, I think the pressure on long end is going to increase now. So probably you could see some steepening in the 10 to 30 year segment. But of course, the market is quite segmented. The long end demand usually comes from insurers. So in that sense, there shouldn't be any disruption in that market. But in general, those yields could actually move up a bit, or rather may not rally as much as was the belly of the curve, right? So there could be a steepening in that segment. The other point is, of course, on the floaters, I think they mentioned 10%. I think even last year it was 10%. Now they're saying it's floating rate bonds plus inflation index bonds. So I'm a little disappointed. I think that number is a bit smaller. Plus the fact is, if you're going to introduce and develop that inflation index market, index bonds market, there has to be enough liquidity. So perhaps they will have to issue more of those bonds going ahead.
Okay, no, that's a fair point for it to be tradable. Okay, but FRBs were also already 28,000 odd crores this year itself.
Yes, for the full year it was 60,000 crores. So that was 10% of the full year.
Fair enough. Yeah. Okay, now let me introduce a tone of negativity into the conversation. Mr. Khajuria, would you worry about the second half?
No, I'll not be worried because I think the mood in the market was very, damp, and people were just thinking of who would buy the bonds. Lots of reports were written as to who would buy and all that. And with this type of program, I think at least first the demand would be ignited, and I would like to share with you that in last 10 years, if you see, RBI had done OMO sales only in 2 years, 2015 and 2018. Now in 2018 they did 900 billion. I mean about 90,000 crores of supply was added by RBI. Now looking into how the reserve money is growing, and accordingly, if you just look at the liquidity deficit to be met, I expect, I think RBI once again coming back on the OMO purchase side. And if RBI also comes back, because this year if you see, 52% of the supply was absorbed by commercial banks. They may be crying, they may be saying that from 640 yields had gone to 780, and you have seen, what type of MTM provision were required in December quarter. But fact remains that 52% of the supply was absorbed by commercial banks, about 33 as usual by insurance. But there was minus 17 by RBI. Now this minus 17, even if it becomes zero, and I am expecting it to be plus 16, plus 17, on the other side, 70, 80,000 crores of OM, nearly 100,000 crores of, OMOs would be needed to just maintain the adequate liquidity in the system also. Or if that be the case, then I think I am not worried about the second half.
Okay, so RBI will be RBI will be the big buyer.
They will have to provide liquidity. The other option for them would be, going on, adding to, their reserves, forex reserves. I don't know whether that capital account supply of greenbacks would be there or not, because current account deficit is widening.
Yes.
So that's not a good news. So on the capital account side, which ultimately results in BOP positive, and therefore, RBI intervenes in the market and generates liquidity. That side is limited.
Yeah,
so I
I
see
agree.
more of OMO purchases.
Okay. So already in the first 2 months, we have seen this huge amount of cash withdrawal from the system. So if liquidity has to be provided, then a OMO could be the route and not necessarily foreign exchange market, simply because there may not be that much of FX flows. Amandeep, final thoughts from you. Would you say that you don't have to worry about the second half? And any other thoughts on the first half? What range this 7.4 can hold for all of April? What is the trajectory for the first half?
Sure, Lata, I think I must give some credit to the government. They have actually moved very smartly on the way this entire calendar has been sort of planned out. Most of the focus seems to be on this 1 to 4 year segment, but you must realize that in the first half, liquidity is going to be somewhat ample. So, I think it's a very smart move to introduce that bucket, because while they are reducing the belly, they've introduced something at the very short end, and clearly there is an increase at the long end as well. Now, under normal liquidity conditions, you would have seen the flattening of curve because of this supply in the 1 to 4 year segment. However, in the first half, you will see, some bit of excess liquidity, which allows this supply to be absorbed without, making a significant dent in the shape of the curve.
Okay.
Secondly, you also have to understand in the second half, there's a general expectation that liquidity will tighten and you may see OMO purchases by RBI. I think the pattern in the second half will be a lot different in terms of the buckets. So while from the new numbers that we're looking at, you are seeing a more or less an even split of just about under 50 for the first half and maybe marginally above 50% of the total, borrowing in the second half, I think the pattern could be a little bit different. So you may not see such a large supply in the 1 to 4 year segment in the second half. I think that's my first takeaway. And I think you're right. The government has moved very smartly on this. We need to wait and watch. There are a lot of risks still out there, and I don't think we should, sort of cast a blind eye to that. So I think Prasanna clearly mentioned there is still, scope for fiscal slippage even beyond this.
Yeah.
You could actually, see some stress building in because by the capital outflows, or just plainly look at oil, right? I mean, crude has again crossed $70. This, is clearly a threshold level which worries the markets on the inflation trajectory. So I think we are not, yet out of the key macro numbers, which can still deteriorate from where we are. But I think purely from a demand-supply situation, it does appear that the government has moved smart. I think the markets will take it very positively. The concern about who will absorb the 6 trillion rupee supply, in the next financial year, I think a lot of that has been addressed through a combination of,
I take your point.
Combination of FRBs, and I think clearly the sequencing of, some of this supply.
Bond markets have not had much to celebrate for the last 6 months. So why should we grieve now and think of what happens after 6 months? For the moment, of course, we'll celebrate. But yes, at the back of the mind, there will be a worry that a lot of wrong things can accumulate in the second half. Oil could be more expensive. Foreign flows may not come through. And fiscal slippage could be there. All the negative things could happen. And you have this 52% of the borrowing calendar still left. Something in all my memory of reporting I cannot remember. It always was 60% plus in the first half. So, I mean, because second half is the busy season policy of credit. So bankers would like to give credit to industry and not to government. So this beats the logic. But let's hope the gamble pays off. But I have just a few quick questions if we have time. Prasanna, what does this mean for the monetary policy?
Ultimately the fiscal deficit is not changing. It's just the way they have tinkered with the borrowing by adjusting the means of financing. So per se, I don't think this matters much for monetary policy. Of course, with the bond market disruption probably is is now, I think we can now kind of put it behind us. So in that sense, the normal market functioning will resume. So to that extent, I guess, I mean, monetary policy can take some signals from the market. I think that was one of the issues. Maybe the yield curve probably was not communicating any kind of proper signal. The noise to signal ratio was very high. That will change. But I don't think one can, I mean, they should read too much into it because, as I said, the fiscal deficit is not changing.
Okay, so the MPC doesn't have to bother much about the borrowing calendar and the impact.
I mean, actually, they don't need to worry that probably they will have to do something more, or rather that the monetary policy will get constrained because of events happening in the bond market. I think that's only positive for them.
Okay, can there be some ulta transmission in that case, Mr. Khajuria? Can we see MCLRs falling?
Well, that's a very difficult question to answer. The reason is the MCLR is a function of what is the marginal cost of deposit.
Yeah, but the marginal cost of wholesale money will fall, no?
I think, I mean, yes, you're right. It may fall, but frankly speaking, your CDs and others still were, only barring your second half of February and March. CDs were ruling more or less closer to your T-bill rates, and there was not much of a spread. And I think with 6% repo rate and your call money ruling below 6% all through, gradually I think you will find that the spread between repo and CD would squeeze. Probably, yes, if you just leave the exception of last 2 months or so, I think there's not going to be much of a difference in wholesale borrowing costs for the banks as a whole. But retail, certainly the way banks were raising the rates, probably that may stop because marginal cost of deposit raising was certainly going up in last 3-4 months.
Okay, that itself will be very good news for growth if MCLRs don't go up. But a final question to you, Amandeep. Return of the bond market? I mean, do you see CP issuances, bond issuances? They had all dried up. Now you see a return of paper?
Yes, I would suppose so. Anyway, you do have, the fresh calendar, sort of also influencing the broad curve for the corporate bonds as well. And I think one of the key reasons why, you saw some degree of limitations on corporate bond issuances was the fact that your risk-free rate curve itself was so high and priced almost, 170 basis points spread over policy rate. I think next year with some, decline, you could see again, corporates coming back to the capital markets. So, the theme which we talked about earlier that you will see some sort of cannibalization of capital market borrowings into the banking sector because, your capital market rates reacted so rapidly and your bank rates, given the current level of MCLRs, were a lot more attractive, may actually shift somewhat back.
Okay. Okay. Well, just the final question to you, Prasanna. I know we've held you up for a long time. But will any of the shadows of the second half, will any of the worries of the second half cast their shadows in the first half at all? Or, the market will just worry about it later?
At this point of time, I think obviously the market will probably put those worries to the back burner. Also, we have to remember, I think we have to see how monetary policy commentary also shapes up. But it's possible that given the recent trend of inflation, maybe even the April monetary policy, at least we can probably say that it won't be more hawkish than it was in February. So it's more like status quo. So definitely that should also help the bond market.
Oh, God.
Okay. All right, gentlemen, thank you very much for giving us all those details. I'll just try and summarize quickly the key points. Ritu, in the first place, the borrowing calendar is much smaller than what it has been in, probably last 10 years. In terms of percentage, the percentage is skewed to a smaller first half borrowing for the first time I can remember since the liberalization of the markets in the post-91 period. It's always been that the first half has the bulkier borrowing. This time it's less than 50%, it's 47%. And secondly, for the first time, the government has introduced a smaller bucket, or rather a short tenor bucket of 1 to 4 years. Until now, we had 5 to 9, 10 to 15, and over 15. But now a new tenor of 1 to 4, which is exactly what bankers were asking. They were getting punished with mark-to-market losses in the longer-term paper. They wanted shorter-term paper. They have got it. As well, the overall borrowing has been brought down on anticipation that, one, there is more FRBs, but as Prasanna points out, it looks like it's the same as last year. But more importantly, small savings are expected to be a better collection this year, and therefore part of that will also be used for fiscal deficit. So, I mean, there's no denying that tomorrow we are going to see a huge rally, akin to the recapitalization day.
Oh, wow.
Going to see a huge rally in the bond market, and therefore in banks, and don't forget NBFCs as well. They will celebrate like it was the return of 2017.
Absolutely, and hopefully expecting bad news in the second half to filter through in the first half, because it's been only 47% of the budget at 6.05 lakh crores. But on that note, we'll take a very short break. News and updates will continue on the other side.